Hello everyone, I'm Dr. Cheryl Dunn and welcome to this video where I'm going to go through some of the key concepts in Chapter 1 and show you how to apply them to various kinds of questions that you might be asked on homework and also on exams. So first of all, what is financial accounting? It consists of two main components. First is we need to measure business activities, and then we need to communicate about those activities to external users. Well, in order to understand that better, we need to think about, first of all, what are business activities and who are the external users. If we think about the business in the context of its external users, we can also then talk about the business activities that surround that the business engages in. First of all, we have financing activities. And financing activities are how the business raises money in order to engage in its operations. This is especially important when the business is first starting up and also when they're planning to expand. And so they can get money from two different main sources. The first source are creditors. And the specific kinds of creditors that we typically talk about are lenders and bondholders. Lenders are either financial institutions or other companies or people who loan money to the business with the expectation that the business will pay them back the principal amount plus interest. And they typically arrange these transactions with what we call promissory notes. Promissory note is simply a contract that says, I will repay this amount with this rate of interest on this date. It will lay out a lot of different terms. They're not super short, but the basics that are going to be important for you to know are how much did they borrow, how much do they have to, or when do they have to pay that amount back, and in what kind of installments. Is it all at once or in multiple payments? And then how much interest do they have to pay on that loan? Then we also have bondholders. When you sell bonds, when an organization or a government agency sells bonds, that's basically a way of borrowing money. And so the bondholders are the people that have bought the bonds that the company then has to repay at a later date. The second main source of financing are investors, and investors might be stockholders, or sometimes we call them shareholders in a company, and also the owners of the business. You'll notice that I made these arrows green to correspond to the financing activities box being depicted in green. And you'll also notice that the inflows of cash that I'm showing here from the creditors and from the investors have a smaller dollar value than the amount that is going to be repaid to those creditors and to those investors. Now, I do want to point out that that's because of the fact that the investors and the creditors wouldn't provide money to the business if they didn't have the expectation that they would end up getting more for their money in return. Now, with creditors, it's mostly guaranteed. There's a stated rate of interest that the business is going to have to pay in order to borrow that money, and so the amount they repay, assuming that they do pay as they're supposed to, is going to be more than what they borrowed. With investors, it's not as guaranteed. An investor might invest money in a business, and the business technically has no legal obligation to pay them back. So they're expecting to make additional money, more than what they put in, but by being able to sell the shares of stock that they bought for more than what they paid for them originally, or by getting dividends over the life of the company and hoping that those end up totaling more than what they paid originally for the stock that they bought. And so there's stock appreciation. That's when the stock goes up in value and then they can turn around and sell it for more than they bought it for. Or there's those dividend repayments those dividend payments that are made by the business to those owners and shareholders. We also have investing activities. And investing activities involve users of two different kinds. First is suppliers, because investing activities is any investment we make or any purchase of a long-term asset, or any transactions involving our long-term assets. And these are things that we use in our business for at least a year. There are things like buildings that we have our offices and our products stored in, warehouses and things like that. There are things like delivery trucks. So you can see the little icon of a building here. You can see the little icon of a truck. Our delivery trucks that we use, or if we're a construction business, all of our heavy equipment are our long-term assets. And then any production machinery. You can see there's a machine here as well. And so we buy those things from suppliers, which are sometimes called vendors or sometimes called sellers. There might be some other synonyms for suppliers. The English language is full of synonyms, and so I can't narrow down some of these terms for you and say you're always going to see it that way, because that's just not how the English language works. And then the business, of course, pays cash for those items. And cash isn't necessarily cash like currency, but it's money from the business, whether it's coming from a bank account or whether it does happen to be cash currency that they have on hand. Then we also have the investees as external partners, because sometimes a company that has excess cash will actually invest that in another company. They'll buy stock in Coca-Cola, or they'll buy stock in Disney World, or they'll buy stock in Lululemon or something like that. And in some cases, they will loan money to another business in order to generate interest earnings. And so investees are not always do not always result in the company buying stock from another organization. In some cases, it's loaning them money and then getting repaid that principal balance plus interest. So you can think of the investees as being sort of similar to the investors and creditors, except the business is on the other side of those same kinds of transactions. And so the business might be buying stock in another organization, and then in exchange for making that cash available to the investees, they're expecting to get dividend payments, or they're expecting to be able to sell the stock for more than they paid for it originally. In which case, then the money doesn't really come directly from the investees, but it is a result of the transactions that they had with the investees. Or similarly, the business might loan money to the investees, just as the creditors would loan money to the business, and they're doing so with the purpose of generating interest. And so they're expecting to get repaid the principal balance from the investees, along with interest payments on top of that. And so there again, you can see that the dollar values coming in from the investees or from the marketplace, resulting from the investments in the investees, those dollar values are higher than the dollars that are going out to the investees. Now, I should point out that even though it's a single dollar sign and a double dollar sign, it's not meant to be proportional. So it's not that they're going to get double the amount back. It's just that it's going to be a bigger dollar value than what the initial payment was. And then you'll also notice that with the suppliers here, I put a double dollar sign on that arrow, and that is to contrast with our next category, where the dollar values of the assets involved are typically smaller. And you'll see what I mean here as I pull this up, because you'll see that I also have some arrows for the suppliers that are blue, that indicate that we have operating activities. And so those blue arrows have a small dollar sign associated with them, because typically what we're buying when we're talking about supplier exchanges are goods and services. And so you see the stack of boxes there that's sort of meant to represent inventory. And the inventory can also be in the form of services, which are pretty hard to depict pictorially. But keep in mind that we can buy services from suppliers. So we can buy accounting services, we can buy attorney services, we can buy insurance, we can buy advertising, and in some cases, the incoming arrow to the business is hard to put a picture on. We do purchase inventory in many kinds of businesses, and therefore I use the little boxes to indicate that. And typically the things that we're buying from those suppliers are individually smaller dollar values. Now, we might be purchasing a lot of inventory all at once, and so we might make an inventory purchase that is bigger than one of our fixed asset purchases. But if you look at the individual items within that shipment, they tend to be smaller dollar value items. That's a generalization. It doesn't always hold true, but that's one way you can sort of differentiate them for yourself. And so in those supplier exchanges, those are the things that we're buying from suppliers on a almost daily basis or a very recurring basis, whereas the fixed assets, the long-term assets that we buy, we sometimes call that property, plant, and equipment. Those are considered investments, and we don't buy those as often. We don't buy buildings every day. We don't buy delivery trucks every day. We're buying those occasionally as we develop a need or expand our capacity of our business. And that's why those are considered investments in our future. Whereas the inventory purchases, advertising purchases, the accounting services purchases, those are happening very frequently, and they're expected to recur very regularly. And so we call those part of our operating activities. They're operating our business on a daily basis. We also pay money to the regulators or government agencies that are part of our operating activities. And so we're going to have to pay payroll taxes, we're going to have to pay sales taxes, we're going to have to pay various other kinds of taxes, occupancy taxes and property taxes and things like that. And so we're paying money to those regulators as part of operating our business. And sometimes it's questionable what we get in return. We do get some things in return. We get the right to do business in their jurisdiction. We get some services such as police protection and fire services if our building catches on fire and things like that. But there's many people that believe that we don't quite get as much as we pay them for in exchange. So I put the question marks there. And then we also have exchanges with our customers. And businesses have different labels for their customers. Some will call them clients, some will call them buyers. There's lots of different synonyms for customers, and it just depends on the type of business. In fact, your doctor's office probably calls their customers patients, right? And so they're providing the goods and services to customers. And again, I put a similar kind of icon for that as I did for the suppliers, because customers and suppliers are basically the same kinds of entities, just on opposite sides of the same kinds of transactions. And so whereas the suppliers are selling goods and services to the business and the business is paying the suppliers for those, the business is selling goods and services to their customers and the customers are giving them cash for them. And again, those are things that are happening on a regular recurring basis, and so we refer to those as operating activities. Now, I should note here that although employees and managers engage in business activities both on behalf of the business and in exchanging their labor for money with the business, we're going to consider them for purposes of this class internal users, and therefore we're not going to consider them as part of the external users, although I would make an argument that in a sense, when we're talking about their exchanges of their labor for cash, I would view them as external users. But this textbook definitely considers them to be internal users, and so that's what we're going to go with. Now, how are you going to apply these concepts? How might you be asked about these concepts on homework questions or on the exams? And this is not a comprehensive list. This is just to give you some examples. And I encourage you to think about what other questions could be asked that are similar to these. And so in these two cases, many of these questions will simply be definitional. So things like, what are the main goals of financial accounting? That's where you would come up with, oh, we're measuring business activities and communicating about those business activities to external users. Which of the following is an external user? And it could be giving you a list of external users and some that aren't. And so it might list, for example, customers, suppliers, regulators, employees, and creditors or lenders or bondholders or something like that. And you would look at that list and you'd go, oh, all of those are external except the employees are internal. They could ask which of the following is not an external user. So those are two ways of asking basically the same thing or testing the same knowledge. They could say, with which of these external users would an enterprise most likely be involved in a financing activity or an investing activity or an operating activity? And so, for example, they could say, which of these users would most likely be involved in a sales transaction with the business? And you would say, oh, that would be the customers. Or they might say, which of these external users would be most likely to be involved in a loan activity? And you would say, oh, that would be a creditor or a lender. We could ask which of these activities is or is not a financing activity, an investing activity, or an operating activity. So we could ask you to categorize a bunch of different activities, such as selling goods and services to customers. Oh, that's operating activity. Borrowing money from a bank. Oh, that's a financing activity. Selling shares of stock to shareholders. That would be a financing activity. Buying shares of stock in another company. Oh, that would be an investing activity. Buying a delivery truck for use in the business that's going to last more than a year. That would be an investing activity. Selling that delivery truck after you've used it for a few years and now you don't have any more use for it, or you need to buy a bigger one to handle more capacity or something like that. That would be an investing activity, even though you're divesting of the investment. Similarly, if you were selling shares of stock that you had previously purchased in another company to get that stock appreciation value from it, that would be an investing activity. So those are the kinds of questions you might see as a result of really getting a good handle on that knowledge from the last couple of slides. Now, how do we communicate the results of those business activities that we're measuring to the external users? First of all, we have 4 different financial statements, and each of these financial statements has an underlying equation. And the first one I'm going to talk about is the balance sheet. And the reason I'm going to talk about that one first is because that equation is known as the accounting equation. Now, all of them have equations, and so I don't know why we've taken this one and given it such prime importance, but it is one of the most important equations that you will encounter in financial accounting. And it is the equation that says that the assets, which are the resources of the business, are equal to the claims against those resources, which are liabilities and stockholders' equity. The liabilities are claims from the people or companies that have loaned us money or have granted us credits. If we buy something on credit, we owe for that, and that is a liability. So liabilities are amounts that we owe. And then stockholders' equity are amounts that have been contributed to the business by the owners and amounts that the company has earned from within. So we have contributed capital and earned capital, and those together make up stockholders' equity. And so, again, the resources that we have should equal the claims against those resources by those that have extended credit to us or who have bought into our company. We also have an income statement, and the income statement, in all of the cases where I say net income or even gross profit, if things aren't going well and our expenses exceed our revenues, then you could intersperse those with net losses instead of net income, or gross loss instead of gross profit, things like that. So in a single step income statement, the equation is really easy. So if it's a single step income statement, we simply take revenues minus expenses equals net income. And that's all there is. You list all the different revenue sources and call that total revenues, and then you list all the different expense categories, and then you say that's total expenses, and then you say revenues minus expenses equals net income. Most companies, especially if they are selling products of any kind, will use what we call a multiple step income statement. And in that statement, we have a series of equations. The first of which says sales minus cost of goods sold equals gross profit. And so we have the second equation here in that purple box is our gross profit equation. Then we subtract from the gross profit the operating expenses, and those are things like advertising. Before I go on to that, I should mention cost of goods sold. So sales or sales revenue is the amount that we sell our goods or services for. So that's the selling price times whatever quantity we sold, all totaled together. And then the cost of goods sold is what did it cost us for those things that we're selling? How much did we buy the inventory for that we turned around and sold to our customers at a higher price? So typically, if we're going to have a profitable business, we have to sell products for more than what we paid for them. Otherwise, if we're just selling them for the exact same amount, we're going to have a lot of other costs that we have to cover as well. And so whatever we sell our products for has to cover those extra costs as well as the cost of the goods themselves. And so the sales minus that cost of goods sold is our gross profit. Next, from our gross profit, we subtract our other operating expenses. So things like advertising, things like the employee salaries and wages, things like the insurance expense, a lot of different kinds of expenses that we're going to have in operating our business. And we're going to subtract those from the gross profit to get what we call operating income. Now, remember that in our business exchange model, we showed that some of what the company does to try to earn money if they have extra cash is investing activities. And so some of the income that they earn is going to be from interest and things like that. And some of the expenses that they're going to incur are going to be from the financing events that happen. And so they'll have interest expense. And so what we're going to do is we're going to take that operating income minus any interest expense. And if there was interest income, we would add that in. So we would net the interest together and either add it if it's a positive amount or subtract it if it's a negative amount. In other words, if the interest expense exceeds the interest income, which is usually the case, then we'll subtract that from operating income, and that will give us our pre-tax income, or what some people call taxable income, or some people call income before tax. So again, lots of synonyms, and so you could see it written any of those ways and just think about what it means, and then you should be able to tell what is there. Once we calculate the pre-tax income, we then apply the corporate tax rate that company falls into, and that would give us the tax expense, the income tax expense. We then subtract that from the pre-tax income, and that gives us net income. So that is the income statement that you see there in a purpley pink color box. Next, we have a statement of stockholders' equity. And the statement of stockholders' equity is made of two components, just as I mentioned earlier that stockholders' equity is made up of contributed capital and earned capital. So similarly, the statement of stockholders' equity has components that correspond to each of those categories. The first one is also sometimes shown separately and called a statement of retained earnings. And it simply says this is the earned capital portion of stockholders' equity. And it says, let's start with whatever we ended the last accounting period with in our retained earnings. Let's add our net income for the current period, subtract any dividends that we issued in the current period, and that will give us our ending retained earnings. Retained earnings is basically the cumulative total of all of the net income that the company has made that they haven't paid back to the owners as withdrawals or as dividends. And so we start with zero. The very first year of operations of a business, the retained earnings that you start with is always going to be zero because you haven't earned anything yet. Then in the first year, it would be the zero beginning retained earnings plus your net income. And then if you paid any dividends to your owners in that year, then you would subtract those. Often in the first year of a company's operations, they don't have enough money to pay dividends. They need to reinvest that money, if they do have it, in expanding their business. And so it's very rare for a first-year company to pay dividends. But if they did, you would subtract those and get your ending retained earnings. And then that ending retained earnings at the end of year one becomes the beginning retained earnings for year 2, and you continue on and add year 2's net income, subtract year 2's dividends. That'll give you the ending retained earnings for year 2, which will become your beginning and retained earnings for year 3, and you continue on with that process over and over. The next component is the component that corresponds to the contributed capital, and that is the beginning common stock. Sometimes it's not always called common stock, but that's how your book is defining it, so that's the term I'm using. But it also could involve what's called preferred stock, or some just lump them together and call it capital stock. So there again, some different terms you might see that are referring to overall the same or very similar concepts. So the beginning common stock plus any additional issuances of common stock is going to equal your ending common stock. And so that those two components together make up a statement of stockholders' equity. And we'll look at pictures of these in just a couple minutes. And then finally, we have the statement of cash flows. And the equation underlying the statement of cash flows says, let's add up the cash flows, inflows and outflows netted together in each of our categories. So let's look at all those operating activities and identify how much cash overall either came in or went out netted together. And then let's add to that the cash flows from the investing activities, and then let's add to that the cash flows from the financing activities. That will give us our net change in cash, which could be an increase or a decrease. And then we're going to take that change and add it to what we started with, which is our beginning cash balance, and then we'll make sure that that does in fact equal the ending cash balance. And if it doesn't, then we'll know that we made a mistake somewhere in our statement and we'll have to go fix it, because we know that the cash we started with plus the cash that came in minus the cash that went out has to equal the cash we have left. So here's some pictures of those statements. You can see that we've got a barbershop example here, and we have an income statement. This is shown in the single step approach, where we've got the service revenues minus the salaries expense minus the legal expense minus supplies expense equals net income. You can see that then that net income flows into the statement of stockholders' equity, and it's in that retained earnings component of that statement of stockholders' equity. You'll notice that this was the first year of business for this company, and so we have the retained earnings shown as 0 to start with, and then we're adding net income of $75 and then subtracting dividends of 0 to get an ending balance of 75. The statement of stockholders' equity also shows that we had 0 common stock to start with, and then we issued additional shares of common stock totaling $500 to the owners, and then that gives us the ending balance of common stock of $500. And we notice that that $500 also then appears on our balance sheet. So you can see the balance sheet up here in the top right corner. We're showing our assets, which in this case, the only asset this company has so far is cash. They have $575 in cash. They have liabilities, starting with, at this point, they haven't borrowed any money from anybody or bought anything on credit, and so they have 0 in their liabilities. They have sold the shares of stock for $500, so that's what gave them their operating cash to start with. And then, but it was a financing cash inflow when they sold that stock, because they were financing their business in order to engage in operations. And then we showed the retained earnings having increased by the 75, and that gives us our total liabilities and equity of 575. So I should say the ending balance of our retained earnings is 75, not the fact that it increased by that much, but that's the ending balance for this company. And then we have the statement of cash flows, where you can see that we start with net income and we make any adjustments that are needed to turn the net income from a what we call an accrual number into a cash flow number. In this case, their revenues were and their expenses were all paid in cash, and so we don't have to worry about accrual accounting for them yet. We'll get into that in a later chapter. Then we have the because we didn't have any adjustments to that, that net income is also our cash from operating activities. And then we didn't have any investing activities yet for this company. We did have that cash flow from financing activities from selling the shares of stock for 500, and that gave us our net increase in cash of 500. And actually that should be net increase in cash of 575. I forgot there was that error in there and forgot to fix it. So please replace the net increase in cash number of 500. That should say 575. And then the cash balance at the beginning of the period is 0, and the ending balance is the 575, which also shows up on our balance sheet. So we verify that. Notice that is not flowing from the statement of cash flows to the balance sheet. That is being verified with the balance sheet there. Okay. In addition to the financial statements, when we're communicating with the external users, we also provide some additional information. Companies will provide to the SEC and to external users at the end of each fiscal year what we call annual reports. And the annual reports consist of disclosure notes, the most important of which is one that summarizes their significant accounting policies. We'll be discussing various policies throughout this semester that will help you realize that accounting is not just black and white. There are lots of shades of gray. There are lots of decisions to be made in how to value something that affect what numbers get reported on the financial statements. Now there are guidelines, there are rules that have to be followed, but in some cases you can choose this method or this method, and they both are following the rules. And so we need to know what are those different methods and which ones have they chosen when they created their financial statements, so that that gives us additional information about how to interpret those statements. They'll also create what's called a management discussion and analysis, which is going to summarize what management thinks about certain things as they are as a result of the business operations that they had that year. They'll also discuss the compensation of their directors and their top executives. And the annual report will also include an auditor's report, because the annual financial statements for publicly held businesses, these are publicly held corporations that we're talking about when we talk about the annual reports and getting audited. Private companies might be required to do an annual report and get audited as a requirement of their lenders, but they don't have to as a regulation of the government. And so it's only if they have certain lenders or creditors that they want to satisfy some terms of a loan that they got, they might have to create those. But we're mostly talking about publicly traded companies when we're talking about these annual reports. And publicly traded companies are companies whose shares of stock are traded on a stock exchange, such as the New York Stock Exchange or the NASDAQ or some other, the American Stock Exchange. There's a number of different stock exchanges in the US. And if they're traded on one of those, then they're considered publicly held. If they're not traded on a stock exchange, they still might be a corporation. They still might have stockholders, but they're privately held. So if I start a business and I own 50% or 60% of the stock, and my sister owns the other 40 or 50% of the business, then that is a privately held company, because you can't just go on the NASDAQ and buy stock in our company. Okay, and so the auditor's report is going to issue an opinion on the fairness. We'll talk a little bit more about that in just a minute. In order to understand these financial statements and the disclosures, you need to understand the accounts that companies have and what those accounts are representing. So let's take another look at that model that we looked at earlier. And this time we're not paying attention to the colors of the arrows, but I didn't change them because I had already created them this way. But what I want to pay attention to now is that different account names that you're going to see throughout the semester, to try to make them make more sense, you can think about where they fit into this particular model. And so, for example, on our income statement, we often have sales revenue or service revenue, or we might even have both. And that is referring to the activity that's happening over here. See if I can kind of highlight that. I don't know if you can see my cursor moving around here. Let me pull up my drawing tool. Pointer options and pen. Okay, so the sales revenue or service revenue refers to what's going on in this exchange with the customers. Okay, so the actual selling of those goods and services is being summarized into the account called sales revenue or service revenue. Cost of goods sold is then going to be also part of this process. It's going to be, okay, what did the company pay for these things here that they sold to the customers? They will then have, you'll notice that the goods and services go to the customers and the cash goes to the business if there's any kind of timing difference between when these activities take place that are represented by these arrows. Then we can have an account called accounts receivable. That's amounts that are owed by the customers to the business as a result of us having already sold them something. We'll see in a later chapter that we could also have unearned revenue, which means that the customers have paid us this cash, but we haven't yet delivered the goods or services to them, and so we owe them those goods and services. The various kinds of expenses are typically found in these exchanges with the suppliers. And so when we buy advertising, when we pay salaries to our workers, we can kind of think of the employees as suppliers. When we pay rent to rent space in a building, that would be an expense that would involve a supplier. And so those activities are found in this exchange. So as you're looking at the different accounts, you're going to sort of be expected to kind of know what they are. And so I want you to try to come back to this model and think about where do they fit into this model. And if you have any questions about what an account is, if you look at it and say, oh, I don't know what salaries expense means, I think you probably do know what that one means. But if you see one that you don't know what it means, feel free to email me and I'll help explain it to you, and I'll come back to this model and tell you where it fits into this model if it fits. There might be a few accounts that don't fit very well, and then I'll just explain what it is in other terms. But most of them, you can think about them in the terms of what business activities are they actually trying to represent and trying to measure. Remember, we're measuring these business activities and quantifying them into dollar values that we're then going to communicate on the financial statements. And so when you see a line item on a financial statement, you want to think, okay, that is summarizing some kind of an account that we're storing information about the quantified values of these business activities. Now, for these previous 4 slides, what kinds of questions might you be asked on that? So how are you going to apply those concepts? Well, first of all, you could have some basic definitional questions, such as what types of accounts appear on an income statement, or on one of the other statements. We could say which kinds of accounts appear on a balance sheet, which kinds of accounts appear on a statement of cash flows, what types of accounts appear on a statement of stockholders' equity. We could also ask what are the equations that are underlying one of these statements. And so we could say, okay, what equation underlies the balance sheet? What equation underlies the income statement? What equation underlies the statement of stockholders' equity? And so that's why I laid those all out on that one slide with all those equations, so you can use that for an easy reference. Understanding the relationships between those financial statements is important, and thinking about which financial statement do we prepare first typically, and that's the income statement. And we prepare that first because we need that net income number calculated so that we can then add that into the retained earnings on the statement of stockholders' equity. And then we need to look at that and be able to post the retained earnings, the ending balance of retained earnings, onto the balance sheet. So then we do the balance sheet next. And then we do the statement of cash flows independently from the others, but then we verify that cash balance with the statement of cash flows and the balance sheet. And so that ordering of how the financial statements are prepared is an important concept to remember. Thinking about What kind of cash flows are the various kinds of activities on the statement of cash flows is important. So as an example of one of those types of things, we could say, what kind of cash flow on the statement of cash flows are the cash collections from customers. And you would think about where those fit into that business model, that business exchange model. And you would say, oh yeah, those are exchanges with the customers are in blue. Those were operating activities. And so those are going to be operating cash flows. Thinking about the purpose of the various accounts, what is accounts receivable, what is sales revenue, and so forth. Again, think about those in terms of that exchange model, and that will hopefully help you internalize what those account names actually are communicating, so that you don't have to just do rote memorization. It's always better if you can actually internalize something and really learn it, as opposed to just memorizing it blindly. We could ask you a question like, what is typically included in an annual report besides the financial statements? And so that's where you would come up with, the disclosure notes, the management discussion and analysis, the auditor report, and so on and so forth. Within that, we could say, what is typically included in the management discussion and analysis in an annual report? And so you can look at what's there in the textbook. It lays those out pretty well. We could also ask calculation questions to apply the concepts on those previous 4 slides. So for example, we could ask a question such as, during the past year, a company has revenues of $900,000, expenses of $600,000, and they paid dividends of $50,000. Calculate the past year's net income for this company. Now, for a question like this, you have to know what you should include as well as what you should not include in order to answer it. Sometimes we will give you extra numbers and extra labels that you don't need to test your understanding of the fact that you don't just need those. If we only gave you what you needed, we would just be testing your ability to do math, and that's not what we're after here. And so net income is revenues minus expenses, so we would take the 900,000, subtract the 600,000, and that would give us net income of 300,000. Notice that we didn't even need to use the dividends, and it's because part of what this question is testing is, do you understand that dividends are not an expense? Dividends are a distribution of net income. They are not part of the calculation of net income. So the company calculates their net income. They decide whether to give any of the earnings back to their owners in the form of dividends. But dividends are not an expense. Another question we could ask would be, if at the end of the year a company has total assets of 1.2 million, total liabilities of 800,000, and common stock of 150,000, what was the company's retained earnings as of the year's end? Well, for that we would need to apply the accounting equation for the balance sheet, right? And we have that equation that says assets equals liabilities plus equity. And so, and then we also have to know that equity is made up of common stock and retained earnings. And so we would say, okay, 1.2 million on the asset side has to equal the 800,000 liabilities plus the total equity. So the total equity must be 4.2 million because, 400, let me think, how is this going to work? It's going to be, just 400,000, because 800,000 plus 400,000 gives you 1.2 million. So the total equity has to equal 400,000, and of that equity, 150,000 of that is common stock. Therefore, the retained earnings must be the difference of 250,000. So again, step 1 is calculate the total equity, which is the 1.2 million minus 800,000, which gives you 400,000. And then you say, okay, equity of 400,000 is made up of 150,000 in common stock plus what amount of retained earnings, and that would be 250,000. The next question, at the end of the year, a company has total assets of 350,000, stockholders' equity of 200,000, dividends of 30,000, and net income of 90,000. How much did the company have in liabilities? So here you have to again apply the accounting equation, and you also have to understand which items do apply and which items don't apply to that equation. And so in this case, we're given two pieces of information that are not needed because they've given us our assets and they've given us our stockholders' equity. We have enough information with just those two pieces to calculate the liabilities. The dividends and the net income are just extra information. And so we would simply say, okay, assets equals liabilities plus stockholders' equity. The assets is $350,000. We're searching for the liabilities. The stockholders' equity is $200,000. So $350,000 equals what plus $200,000? The answer is going to be $150,000. The next question, given a list of accounts and dollar values, prepare an income statement, statement of stockholders' equity, balance sheet, and/or statement of cash flows. And I would encourage you, if you're asked a question like this on the homework, to get out your book and see what those things look like, and then practice those enough times that when you get to the exam, you won't have to use a book because you won't be able to use a book. And so you'll have to know what is on those statements and what are they communicating. The next question is a potential, and again, none of these questions are going to be asked verbatim or with the same numbers or anything like that. These are just examples. And so a company ends an accounting period with assets of $100,000, liabilities of $54,000, dividends for that period were $6,000, revenues for that period were $28,000, and expenses were $18,000. And this time they're asking you to calculate net income and the ending stockholders' equity for this company. So the first thing you'd want to do is calculate the net income because you have all the pieces you need for that, which is revenues of $28,000 minus expenses of $18,000 would give you $10,000 in net income. Then you would say, okay, if assets are $100,000 and liabilities are $54,000, then stockholders' equity must be the difference of $46,000. So notice that we didn't need to use the dividends at all there. We had enough information with everything else that we had. Another kind of question that often gets asked about the concepts that we've been talking about are they'll give you some partially filled financial statements and then require you to use your knowledge of the various equations and how those statements fit together to fill in the blanks, to fill in the missing values. Sometimes such a homework problem might be very complicated because they might have you, they might give you pieces that require you work backwards from a balance sheet to get to the pieces of information that you need to calculate net income, for example. Or they might give you information from the statement of stockholders' equity that you need in order to calculate numbers that are on the income statement. So you have to really think in those hard problems, write out all the equations and then say, okay, I know simple algebra, because none of the math we do is any harder than simple algebra. So if you don't remember simple algebra, you do need to study that because you will need some of that. But as long as you can do simple algebra, you can do those kinds of equations. It's just a matter of thinking through those relationships between those financial statements and how they fit together. Okay, so we've gone through the fact that we're measuring business activities, we're communicating them to external users. We're doing so in the form of financial statements. We've talked about the kinds of line items that are on those financial statements. But who's to say those financial statements are prepared correctly and are providing good information? Well, the SEC, and in fact, companies have been doing accounting for many, many years. But back in the 1920s, they weren't doing such a good job. And most of you have learned in your history classes about the Great Depression that kicked off with the stock market failure in 1929. That was precipitated largely because companies were not giving valid information to their shareholders. They were manipulating the numbers that they were showing and therefore they were causing investors and creditors to make bad decisions about who to invest in. And so the Congress ended up establishing the Securities and Exchange Commission, also called the SEC, to enforce proper application of financial reporting standards by publicly traded companies operating in the U.S. Because it was those publicly traded companies that were causing the problems. The privately held companies, they don't need to mislead anybody because they're only run by their owners typically, or their owners trust the people running them because they know them. So that's a different ball game there. But for those publicly traded companies, the SEC said, hey, all right, first of all, we've got to have some good reporting standards, and then we've got to have somebody to enforce that those standards are actually being applied by these publicly traded companies. And so the Financial Accounting Standards Board was given the responsibility of generating those standards, and the standards are called Generally Accepted Accounting Principles, also known as GAAP in the US. And there's also a body that now is trying to develop some global standards. It's called the IASB, the International Accounting Standards Board, and the global standards that they are developing are called IFRS, the International Financial Reporting Standards. And the IFRS and GAAP are pretty closely related. I should say IFRS and US GAAP. Other companies have their own versions of GAAP. And the US GAAP and the IFRS standards are pretty similar. There are some places where they diverge, but for the most, and they haven't come to agreement on which is the right way to handle those. US thinks our way is right. The international community thinks their way is right, and they tried to make them converge, and they haven't been able to accomplish that. But at least the differences are pretty well known, and so when you're looking at statements, you just need to know, were they prepared with generally accepted accounting principles in the US, or were they prepared with the IFRS standards globally, and then you can make your decisions accordingly. And then the other thing that gives external users confidence is the audit industry. So we have auditors that actually examine the company's financial statements and their accounting systems and what generated those financial statements to issue opinions on whether the company did prepare those statements in accordance with generally accepted accounting principles. So let's look at the FASB's conceptual framework and what they say about the qualities that accounting information should have. And there is an overriding objective called decision usefulness. That means that the information that we provide needs to be useful for making decisions. There are a couple constraints on that in order to be useful, ideally we would provide as much information as we possibly could, but sometimes the benefit of that information is going to be exceeded by the costs. And if the costs exceed the benefits, then it's not useful. So we say it's only useful if the benefits of that information exceed the cost of producing it. And then the other constraint is materiality. And that means for this information to have decision usefulness, it needs to make a difference in somebody's decisions. So if a dollar amount of something is so small that whichever way we accounted for, it wouldn't make a difference to the user, then we don't need to worry about which way we use to account for it. We just account for it one way or the other, and it's not going to make a difference to the user, so that's okay. The primary characteristics that information should have in order to be useful are relevance and faithful representation. It should also be verifiable and timely and understandable and comparable both over companies and across time, but those are what we call enhancing characteristics. So the primary characteristics of decision usefulness are relevance and faithful representation. And what it means to be relevant is that it should have both confirmatory value and predictive value. In other words, we should be able to confirm that that is in case the value that somebody assigned to it. We should be able to come up with that again if we use the same method as the preparer used. And then the predictive value means that it should have some usefulness in making predictions about the future. The faithful representation means that it really is representing what it says it is. So we need the information to be complete, to be completely describing what it is representing, to be neutral, so it needs to be prepared from an independent perspective, not just from biasing in favor of the company that's reporting it. And it needs to be free from material error. So it has to be correct enough that any error isn't going to affect somebody's decision making. And then those audits. Those are required by the SEC for all publicly traded corporations in the U.S. They are optional for privately held companies, but they might be required by lenders of those privately held companies. So especially really big privately held companies often do have audits by public accounting firms, and they will then provide the results of those audit reports to their owners. And the result of an audit, we sometimes refer to that as the report of independent auditors. Sometimes we instead just call it the auditor's opinion, kind of as a shortcut label. Those are the same thing. So if you see report of independent auditors or you see auditor opinion, those are the same thing. And they're basically giving the auditor's opinion as to whether the financial statements were prepared in accordance with GAAP and whether they're free from material misstatement. And there's 4 choices about what opinion they could issue. First, they could give an unqualified opinion, which means they think that they're totally prepared in accordance with GAAP. They might give an unqualified that has a little bit of extra explanation or emphasis. So they'll say, yeah, it's reported in accordance with GAAP, but you need to really pay attention to this aspect of what they're reporting. They might give a qualified opinion, which means they're prepared in accordance with GAAP except for this one area. And here's where it's going astray from generally accepted accounting principles and how you should look at it as a result. Or they could give an adverse opinion, which says, we don't believe that they are free from material misstatement, or we don't believe they're prepared in accordance with GAAP. There's something that's majorly wrong here. Now, you don't see adverse opinions very often, and that's because usually during the course of the audit, the auditors will get the company to change the report so that it does conform with GAAP. Or they'll withdraw from the audit and they'll just say, I can't issue a good opinion on this, and you're not going to want to pay me if I'm issuing a bad opinion, so I'm just withdrawing from this audit altogether. That does happen sometimes. Okay, so these previous 3 slides regarding these the FASB conceptual framework and the auditors and things like that, what kind of questions would you be asked on those? Those are going to be definitional. Again, this is not a comprehensive list, but just some examples of questions that could be asked. They could say something like, what rules guide the preparation of financial statements for publicly held U.S. companies? And of course, that would be the generally accepted accounting principles, or GAAP. What governing body oversees enforcement of financial reporting requirements? Hopefully you remember that that is the SEC that is in charge of enforcing of that. Who provides assurance that a company's financial statements comply with GAAP? That would be the auditors. How do the auditors help give users confidence that companies' financial statements comply with GAAP? Well, they examine their financial statements and their underlying accounting systems, and they issue opinions accordingly. What are 2 constraints on providing external users with financial information? That would be that materiality constraint and also the cost benefit constraint that we talked about. What is the overriding objective, or sometimes it's called the pervasive criterion of accounting information, and that is the decision usefulness, that it needs to make a difference in the users who are making the decisions. What are the components of faithful representation? Well, remember, that's the concept that it is what it really is. It's totally representing the real world activities that it's supposed to represent. And we said that for that to be true, it needs to be complete. It needs to be prepared from a neutral perspective, not biased in the company's favor or against the company, either way. And that it needs to be free from material error. And then what are the components of relevance? That would be the having confirmatory value. So if somebody else prepared them using the same methods as the one that did, they would come up with the same information. And the predictive value, that the information provided is giving us some element that is going to help us to see what's going to happen in the future. Okay, so that is it for chapter 1. As you are working on homework 1 or as you are studying for the exam with respect to chapter 1, please contact me with any questions that you have. I won't know how to help you if you don't let me know how to help you. And so please contact me at dunsey@gbsu.edu. We can set up a Zoom appointment if you need to talk with me face-to-face. And if you need to meet with me in person, that's a little harder this semester because I'm away a lot. But if I am in Grand Rapids, I'll be happy to meet with you in person. But otherwise, I assume that you signed up for an online class because you don't mind the online method of communication, and therefore that's going to be the primary method that I will use for meeting with you is on Zoom. So do let me know what questions you have, and enjoy the rest of your day. Thanks a lot.